Something unusual is happening in the markets right now. Stock prices are pushing to record highs. Valuations are stretching beyond historical norms. And optimism feels almost universal. Open any financial app and the message is the same. Growth, opportunity, upside. People aren't asking if prices are too high anymore. They're asking how much higher they can go. This kind of confidence feels exciting. It feels comforting. But historically, it's also dangerous. Because whenever investors start believing risk has disappeared, history quietly begins to repeat itself. Today, we're going to examine why many experts believe a new financial bubble is forming, how it closely resembles past market cycles, and what long-term investors can do to protect themselves, without fear or panic. Every major financial bubble begins the same way, not with panic, not with chaos, but with excitement. In the late 1990s, the internet was changing the world, and that change was real. Email, online shopping, digital communication. None of it was fake. But investors began to assume that every company connected to the internet would succeed. Profits stopped mattering. Cash flow stopped mattering. Stocks rose simply because everyone believed they would keep rising. And as prices climbed, skepticism faded. Euphoria is powerful because it doesn't feel reckless. It feels logical, at least in the moment. As the dot-com boom expanded, something subtle happened. Risk wasn't eliminated, it was ignored. Analysts justified impossible valuations. Media celebrated overnight millionaires, and caution was labeled pessimism. The belief wasn't that prices might fall someday, it was that they never would. And when belief replaces risk management, markets become fragile, even if they look strong. After the dot-com crash, confidence returned in a new form: housing. Home prices climbed steadily year after year. Banks believed diversification made mortgages safe. Investors believed housing was immune to collapse. Homebuyers believed prices could only go up. All of those beliefs depended on one assumption: that history had changed. When that assumption failed, the consequences were global. Markets froze, institutions collapsed, and millions of people paid the price for excessive confidence. Now we arrive at the present moment. A new technological revolution is underway. Artificial intelligence, automation, and data-driven systems are reshaping industries. The innovation is real. The impact will be real. But markets aren't just pricing in success. They're pricing in perfection. Some companies are valued as if growth will be instant, uninterrupted, and permanent. And that's where caution becomes necessary. Real innovation unfolds slowly. It faces setbacks. It requires capital, time, and adaptation. But market hype moves fast. It compresses decades of expected success into today's stock price. When expectations move faster than reality, disappointment becomes inevitable. Not because the technology fails, but because prices moved too far too fast. For over a decade, money was unusually cheap. Interest rates stayed near zero. Risk felt manageable. Losses felt temporary. That environment reshaped investor behavior. People learned to expect quick recoveries and constant liquidity. Even though rates are higher today, the psychological habits of cheap money remain, and markets don't unlearn habits easily. This is the most dangerous part of any bubble, the feedback loop. Prices rise, so people buy. People buy, so prices rise. Eventually, participation becomes emotional rather than analytical. At that point, fundamentals stop leading the market. Sentiment does. And sentiment can change far faster than profits ever could. Today, warning signs are emerging quietly. Valuations detached from long-term averages, rising leverage, growing volatility beneath the surface. At the same time, large institutions are behaving differently than headlines suggest. They're hedging, they're rotating, they're preparing for multiple outcomes. That gap between public excitement and private caution is worth paying attention to. This bubble may not end with a dramatic crash. It may deflate slowly. Years of sideways markets, underperforming returns, capital trapped in overvalued assets. That kind of decline doesn't make headlines, but it quietly destroys wealth. Smart investors don't try to predict exact turning points. They manage risk. They diversify across assets. They keep liquidity available. They avoid chasing narratives at their peak. They understand that missing a final rally is far less dangerous than being overexposed when reality returns. History doesn't repeat exactly, but it echoes. And right now, the echo is familiar. A new financial bubble may be forming, and preparation will matter far more than prediction. If this helped you think more clearly about today's market, consider subscribing. And tell me in the comments, do you think we're in a bubble or just witnessing the next evolution of growth?